All right. So, welcome everyone to this beautiful session. And today we're going to be talking about supply and demand trading and what actually supply and demand trading is. And we'll be able to learn some few concepts on supply and demand. And before we begin, I'd love to introduce myself. My name is Benji Forex. I am a full-time Forex trader, mentor, tutor, and also a financial expert. If you didn't know, and welcome, I welcome you on board. I've been trading for the last 5 years. This is my 6th year now, and trading has really changed me, and also it has been able to change my life in very many ways. Okay, so trading is actually very simple. The only thing that we do is we actually complicate it, or we follow people who actually misguide us. So if you get someone who can be able to guide you well, things are going to be much better. So on supply and demand trading, I would love us to tackle on some few things. But before we begin, I would love
it's okay.
I would love us
So
to check on what we'll be able to learn. All right, so that's the first thing. We'll be able to check on what we'll be able to learn. So please, your mic is muted and also your video is off. We don't want to see you. All right, so first things we learn, number one is the core concepts. Okay, the core concepts on what? The core concepts of S&D. Okay, we learn about the core concepts of S&D. Okay. Number two, we'll be able to learn is how the market, okay, really moves behind the scenes. There's so much that you guys need to learn and understand how the market really moves. And number three, how to trade S&D. Okay, and the last one is how to identify. The last one is how to identify high probability, okay, S&D, okay, supply and demand areas. So this is my key trading strategy. This is what I actually started using in my second and third year in trading, and actually it really revolutionized my trading career, and it actually made me start making some good amount of money from trading. Previously, I used to trade like just any other trend lines, support and resistance. Okay, so those are what I used to do. Kitambo, support and resistance and trend line, that was my thing, and moving average. That was my thing back then in my first and second year. And I learned about now supply and demand, and I was able to actually understand how the market really works. And there's another concept that is called the 4 cycles. The market 4 cycles. Okay, so you really need to understand when the market is mature to trade, when the market is not mature, when the market is pulling back, when the market is creating the impulsive move, and when the market is creating now the continuation move. So you need to understand which phase of the market this you actually trading. Okay, so you'll be able to understand these things. Okay, so what is supply and what is demand trading? So in simple terms, okay, supply and demand trading is the SMC kind of trading way. Okay, and with the SMC, we are able to learn and know that we really need to trade like how the institutions actually trade. Okay, so whenever the institutions are in play, they usually leave what you call footprints, and footprints are things to do with supply and demand. Okay, but with supply and demand, you can be able to dive in and be able to get some few confluences such as order blocks and also fair value gaps. Those are imbalances. So those are footprints that the smart man usually leaves behind. And for us as traders, is just to make sure that we are aware of those footprints and we capitalize on those moves that actually the smart money left behind. So in simple terms, supply and demand is a smart money concept based on how big institutions, okay? And these big institutions that people usually hear, the sharks, okay, usually have, these are the banks, okay? we usually have the hedge funds. All right. We usually have who else are usually in play? We usually have banks, the institutions or the large financial institutions. Okay. Really have large financial institutions. So these are the big players who are actually in the markets, okay? And usually have also the liquidity providers. You can also add the liquidity providers as the smart money, okay? So these are people that we usually look up to, okay? They might be few in the market, but the volumes that they actually control is actually big and large. And what we do necessarily as traders, as SMC traders or ICT traders, is just to check how the banks, the hedge funds, the big financial institutions, the liquidity providers, how did they actually approach the market, and if was there any footprints that they will actually be able to leave as they moved, okay? And once they moved, okay, like this big move that is actually here, like this big move that is actually here. And with this move that they actually moved the market, okay, did they leave any footprints, okay, in the market? And these footprints, we usually check them using the chart. And this chart is from TradingView. And this chart is an X and Y chart that shows on the x-axis is time, okay? Usually have time, and on the y-axis is we usually have the price, okay, of the instrument that we're actually trading. So did they leave any footprints? Definitely. If they left any footprints, now our work as traders is just to make sure that we're able to mark out those footprints and we trade accordingly. Okay, sawa. So we have people who trade imbalances only. We have people who trade order blocks only. Okay, and usually also have people who trade the imbalance and the order blocks also. All right, so we're going to dive into that, and we're also going to check how well can we be able to use those confluences to our advantage. Okay, so these are the big institutions. All right, so in simple terms, as I say there, it's how big institutions actually move the market. Price moves because of imbalance between buyers and sellers. Okay, and a demand area, all right? A demand area, in simple terms, it's good also be able to understand what a demand area is and be able to advantage. So what is a demand area? Now this demand area, right, it's an area where buyers are strong, okay, and where price has drastically moved, okay? Sorry for that. Yeah, so let's continue. Perfect. Confirm that you can be able to see my screen once again. Just confirm. Just confirm if you can be able to see my screen again. Okay, perfect. So let's continue with this session so that you can be able to finish up with it. So what is the demand and what is the supply zone? Okay. So as I said before, supply and demand trading is actually a SMC concept based on how big institutions such as the banks, the hedge funds, okay, the institutions, the large financial institutions, and also the liquidity providers, how they usually move the market. And there's a way that they usually move the market. And price moves because of liquidity or because of imbalance between buyers and seller. So a demand area, which is this area, all right, is an area where we have strong buyers, okay? And these strong buyers, we cannot be able to see them with our eyes, but you can be able to see them with how the chart actually moves, okay? It's as simple as that. So whenever we have big impulsive buys, okay, that has happened in the market, there's usually a demand area that has been formed on this particular area. And our work as traders is simple, is to wait for the market, come and pull back, okay, to this particular area of demand. Then from here, once we have good price action, we can be able to get in and also take the buy, okay? So what is a demand area? This is an area where we have lots of buyers. So in simple terms, a demand area is a strong area where we have a large supply of buyers. Then we have the opposite case, which is the supply, all right, which is the supply, and we'll talk about it now. And what is a supply zone? A supply zone is an area where sellers are very strong in the market, okay? And we can be able also to see it using the chart. And this is how we can be able to see it. Now, this is the supply that we are having in the market, probably just before the market decided to actually dump, okay? We had some accumulation, okay? Then from there, the market decided now to dump from there. And this is the supply zone, okay? So a supply zone is an area where it's characterized by having lots of strong sellers, okay? So this is an area where we're having sellers, okay? So this is the core concepts of supply and demand. So supply and demand, the core concepts, and we usually have what we call characteristics of valid supply and demand areas. And I would love you guys, if you're writing down, please make sure that you write this one down, okay? Supply and demand, core concepts of it. Number one, or for any supply and demand to be valid, or valid S and D, okay, the first thing, number one, is usually say it has to create what you call an imbalance. It has to create an imbalance. Remember, we have been able to talk about the market structure. That was our volume one. The volume two, we were able to talk about imbalances, market imbalance and market inefficiency. That's what we're able to talk about. And today we're talking about supply and demand. Now we are combining all these concepts into one. Then it has to get an imbalance. And now what is an imbalance? An imbalance is an aggressive push up or an aggressive push down in the market. And if the market moves in one direction only, that's already an imbalance. Like this example that is actually happening here. So all this is an imbalance. The imbalance, it can be categorized by either fair value gaps or either by multiple fair value gaps, or also when the market moves in one direction without even pulling back. And as I said, the market doesn't move in one direction only, like this, all right? The market doesn't move in one direction that way. The market has to move in a zigzag manner. The market has to push up, push down, and actually mitigate 50% of this move, okay? Then push up again and push down if it's on an uptrend, okay? It's as simple as that. So the market moves that way. But if you find a market that moves in one direction only, that's an imbalance, and the market will always come back. And this is what actually happened in we called in end of January, when the market decided to dump, and also early Feb, all right, because the market had pushed up the entire of January and it didn't create any pullback whatsoever. So a valid supply and demand, it has to create an imbalance. So this is an example of an imbalance, all right. Number two, it has to create what you call a break of structure, all right. It has to create a break of structure or a boss, or what we usually call change of character, all right, or also market structure shift. Either way, how you love to write it down, depending on who taught you, all right. So it has to create a break of structure, and these breaks of structures are actually here. We can have this as our break of structure with this supply. This is just an example, all right. Then we have also another break of structure that is actually here. We also have a BOS, all right. We have a BOS there. Then I want to clone this and make sure that this is actually here. Perfect. So those are breakout structures that we have. Okay. And the last thing for any valid and supply, any valid supply and demand area, it has to do what? It has to collect liquidity. Okay. LQD, I usually write it as LQD, it has to collect liquidity. And this liquidity, I will show you how we are going to be able to see in a given price chart that is actually here, or in a given market, and I'll be able to explain how we can be able to do that. Okay. So those are what we usually call a supply and demand area that is actually valid. We usually have multiple supply and demand areas in the market. Okay, we usually have the main ones, and also we usually have the minor ones. Like the main one is actually here with this example. Then we usually have minor supply areas that are actually here. Okay, and this is the valid supply that we usually have. Okay, and this is also another supply zone, but this is a minor supply zone. So I want us to go to the charts. But before we go to the charts, I just want to show you how we can be able to apply these concepts, okay? Because sometimes you'll be able to see that the market will be able to pull back, all right? We'll be able to pull back, come to this supply, drop, okay? Then come back again, okay? Tap into the supply zone and now be able to have that big drop that we actually want to see in the market. So majorly, we'll be able to see these kind of setups, and our work as traders is simple. Just note all of them and just note which one is the main one and which one is the minor one. So it's very important to be able to understand those things. Okay. So price moves because of imbalance. So more buyers than sellers, price rises. Okay. And whenever we have more sellers than buyers, the price falls. So retail trading reacts, institution cause the move. So for us, we usually react after the market reacts to our areas of interest. And we usually have different, as I said, supply and demand. We have usually have the main supply, and usually have whatever happens in the middle of the range is what we usually call the minor, and that's what I usually call noise in the market. So I usually love trading only high probability supply and demand areas, and this is how I usually get my setups and also my signals and the entries. Okay, so how do you usually identify strong supply and demand areas, or the main supply and demand areas? Very simple and very clearly. Number one, just want us to I want you to note how to be able to note, okay? Because we have already noted that it has to create an imbalance. So these are characteristics of valid supply and demand areas, okay? Let me just write them down. These are characteristics, okay? Characteristics of valid supply and demand areas. Okay, so these are characteristics of valid supply. Then I want us to check on how to identify them now. Okay, how can we be able to identify them? And I want to make it simpler for a beginner to be able to understand, and also for someone who is also a fresh, okay, and also intermediate and also advanced traders. So how do we identify? How to identify? How to identify now? How to identify strong or valid S&D? We usually call them S&D. So the first thing that we're able to see is to identify them is just actually checking them in the market. And the first way we usually identify them is number one, impulsive moves. Okay, impulsive move. And when I say impulsive move, or impulsive move is the strength in which the market actually moves. Okay, how the strength. Okay, how did the market actually move? Okay, because with strong movements or with strong supply and demand areas, the market has to impulsively drop. Okay, not just drop this way from here. The market drops and pulls back. Okay, drops and then pulls back. That's not a valid supply and demand area. Okay, the institutions, as I said, how we usually check on how the institutions work is very simple. Whenever they get into the market, the institutions, the big players, the smart money, okay, they usually get into the market within a short period of time, probably 30 minutes, or during a session, open and close, probably for 3 hours. Okay, so it depends on how they usually enter in the market. So whenever they enter in the market, they usually inject lots of capital and lots of liquidity in the market. And whenever they get in and probably they initiate a sell, market drops significantly, quite hard. And whenever it falls, the market has to pull back. Okay. Then from here, because this is the area, the main area where the market actually started dropping, and this is the origin of the area, then from there, that's where we'll be able to do what? That's why we'll be able to take our sell, because this is the origin of the drop that actually happened. Okay, so this is the impulsive move that I'm talking about. The market has to, if it's a supply zone, it has to dump significantly quite hard. If it's a demand zone, it has to buy quite hard. So those are the things that we usually check in the market. Okay, and whenever it drops or pumps aggressively, it will create an imbalance. Okay, the second thing on uh, how to identify a strong supply and demand area is freshness. Okay, freshness of the zone. Okay, freshness of the zone. So what am I talking about? I'm talking about, was it mitigated? Okay, did the market actually mitigate it just before? Let's say, for example, let me use this as an example. Okay, you can see this here. Okay, people will term it as an inducement zone. That's totally okay. People will term it as a buy side liquidity. People will term it as liquidity. Nevertheless, so I want just to make sure that this is here. So with this kind, I've just adjusted it, okay? With this kind of movement that is actually here, the market dropped. Then this price zone that you're seeing here, or this movement that is actually here, the market was able to mitigate this supply. So whenever we have a mitigation of this supply, it makes this supply not a strong or a valid zone. But before, okay, the market was here, so this supply zone has not been mitigated. Mitigation or being mitigated means the market was able to tap into that supply and actually do or moved according to the structure. And the structure is actually sells, as you can see. The market is actually on a bearish run. So this is a fresh supply zone. It has not been mitigated. So whenever you see fresh supply and demand areas, they have not been mitigated, it shows that that area is a very strong supply and demand area. And also another thing, time spent at the base. Time spent at the base. Okay, so this is also a very important concept. Okay. Whenever we have short base, we usually have what we call strong institutional entry. And whenever we have a long base, this is a weak retail consolidation. So this is what I'm talking about. Whenever we have lots and lots of consolidation, okay, the market decides to consolidate, okay, for a very long time, okay, for a very long time, then the market actually pumps. Okay, so this shows that this was more of retail trading that was actually happening. The retailers actually took a lot of time before probably the market actually pushed up. But if we had some sorts of consolidation, just short based consolidation, probably a sweep, then we have a push. Okay, this shows that this is a very strong institutional entry than this. Okay, you utapata in a very strong institutional entry than which one? Than this one. So these are very important things to consider. People who do smart money, the rally-based rally-based drop-based rally, all those sorts of things. Those are not my things. That's not what I usually check in the market. Okay. A very good example is this area that is actually here. This is a very good supply zone, okay, that you can be able to see in the market. The market has imbalance, and also it has a good valid order block. This is AUD/USD on the H4. All right. So this makes it a valid because we didn't have lots and lots of consolidation that actually took place here. Okay, but whatever you're seeing here, this is now more of consolidation, but this is retail consolidation. Now, this is not institutional strong entry. So this makes it valid than these types of entries are actually here. And you're going to be able to see whenever the market comes back to this particular long base entry, the market will actually be able to do what? We'll be able to wick through it fast. Let me just show you as an example. You'll be able to wick through fast. Then the market will now start buying from there. All right. So mostly and majorly, don't check on the length of the base. Okay. So long base means that's weak. retail consolidation. We are not interested in this. But whenever we have this, especially when we have a sweep of a low that was actually here, the market didn't stay for long, the market pushed up. Now this is makes it more valid, more valid. Kind of a supply and demand. Okay, so that's number 3. We have time spent at the base, then the last one, okay, which is number 4, distance of the move. Distance of the move. Okay, so we might have a sharp impulsive move, like the one that is actually here, but also the distance of the move, as you can see, the move originated from that area all the way down to this particular area. So this is the distance of the move. So the longer the distance, the valid the supply zone. So whenever we have this kind of supply and demand areas where we have big impulsive move, it is very fresh, it has not been mitigated. The time spent on the base didn't take a lot of time, and also the distance of the move was actually quite big. This makes the supply and demand area being a very valid supply and demand area, and that's actually going to make our work so simple. Now what we usually do is we wait for the market. Ever heard that people make money by waiting more than by either trading? Very true. So the market will have to wait for it on this supply area. Then we'll talk about how to now get into these types of trades. That's going to be next week on Monday. Tutaangalia, we'll be able to check on how can we be able to enter in these supply and demand areas. Okay, because it's very important for us to be able to actually know or how to be able to get in, because sasa tuko na 3 entries criteria. I know and I understand that you guys know too, which is the aggressive entry, and we have the conservative. Now we have the pro type of entry, okay, which we call the sniper pro method, and we'll be able to talk about it next week on Monday. So each and every week on Monday we're going to be having all these sessions, okay, and they only happen in the private VIP community only. Okay, so we're going to be able to see how to be able to actually take a trade from this when the market comes and taps into our supply area or our demand area. What or how can we be able to approach this market now? Because we want to hit the buy and the sell button, but for us, because it's a supply, we want to hit the sell button. At what particular time can we be able to hit the sell button? And what are we supposed to see before we hit the supply? And where can we be able to target? Okay, that's what we usually call the take profit. And where can we be able to place our stop loss? So those are the things that we're going to be talking about. So we have 3 types of entry techniques. The first one is the aggressive entry. Then we have the conservative entry. Then we have the sniper pro type of entry. We're going to talk about all of them. Which one do I use? I will share with you on Monday next week. So don't worry more about it. So for now, we have been able to learn supply and demand trading. Okay, and this supply and demand trading is where the institutions were able to come in and they move the market extremely. Okay, and how can we be able to see how they were able to move the market? By having those impulsive moves, okay, big institutional candles. I usually call them the big institutional candles that actually move the market. Okay, and also the freshness of the zone, it has not been mitigated, time spent on the zone, and also the distance of the move, and also characteristics of a supply, of a valid supply and demand area. Lazima create balance. That's one. Number 2, lazima create what you call a break of structure or a change of character. Okay. Then number 3, it has now to collect liquidity, and this liquidity, now this is what I really wanted to talk about, and this liquidity is something to do with this. Okay, so you can see this area, it's more like an inducement zone. Okay, and more or less you're going to be able to see the market doing this type of movement. Okay, let me delete this for now. Okay, so the market has fallen all the way down to this particular area. Just want you guys to see how the market will be able to react from here. Okay, now the market now starts pulling back. Now the market, as I said, starts doing what? Pulling back, and this pullback has to be low volume type of pullback, okay, not an aggressive one. Okay, has to be low type of pullback, and the market decides to do what? Decides to react from this particular area. Okay, we'll talk about this more, and this is what we usually call liquidity. You can call it inducement, you can call it liquidity, you can call it This is buy side liquidity. Okay, then the market, whenever it comes to this particular area, it might create equal highs. Okay, and decides to drop. Okay, so whenever the market does this, this validates our supply zone. Okay, majorly the people who will be able to enter from this particular minor supply, or what I usually term as a SMC trap. For me, I usually term it as an SMC trap. Uh, they are early buyers. They are people who are not very patient in the markets. Okay, and they're going to be induced by getting into this particular area, and they forget that this is the origin where the market started dropping. Okay, and they forget that below it we have an imbalance, and above it we have a good order block, and this is a bearish order block. Okay, so they get in here, okay, and they think that the market is going to go all the way down to what, to this particular low that was created by the market. Okay, and that's going to be our drawn liquidity for now. All right, so but the market actually gives them a fake move by actually dumping, then now starts aggressively moving up. If they didn't place their BE, or they didn't apply proper risk management, they're going to be taken out, and the market now taps into a supply zone and gives us a good movement or a good price action, and decides to fall all the way down, okay, from this particular area. So those are the things that I usually look out for. Okay, these types of fake out whenever we have this type of an entry. Okay, we have our supply, and the market has created this like an equal high. This is liquidity for us. The market reacts from this particular zone. That's going to be a high probability kind of a setup, and from here we'll be able to see that the market is going to react from that particular area, okay, with some few pips from this particular area, and then from there the market now comes to our main supply region and reacts from it, and this is where we're able to take the sell, stop loss above our supply, then we target this particular low that the market was able to create. So that's what we usually do, that's what we usually have in the markets most of the time. All right, so until there, I hope you guys are able to understand the supply and demand kind of the strategy. Okay, it might look easy, but it takes a lot. It has a lot of things, okay, that actually comes with it. Okay, so other things, just before we dive into the markets and see some few example, I'll just share 2 or 3 examples of supply and demand, the setups that we have been able to take, okay, with our VIP community. So there's some things, or there's some common mistakes that traders actually do that are actually not so good. Okay, and those common mistakes traders do from these supply and demand areas, common mistakes traders do is, number one, is they usually think that trading that every zone is a valid supply and demand. So whenever thinking that every zone is a valid SNB. Okay, so as much as we usually trade zone to zone, not every zone is a valid supply and demand area. Okay, number two is ignoring what we usually call trend. Whenever we ignore the trend, now that becomes a problem. Like this example that is actually here, the market clearly is on a downtrend. Okay, but sometimes it works, but majorly it doesn't work. But you, on the other hand, you are looking for buys, okay, especially on these particular zones that are actually here. Sometimes they do work, okay, but as long as this will take you lots and lots of practice to be able to get these types of trades, because now this market currently, it has had an impulsive move. The market is now pulling back. The market has hit our supply area. We need to see a reaction. We usually say we don't react before the market reacts, which is quite okay. Okay, so once the market reacts from this area, then the market decides to push lower, and this is where we look for sells. And the problem is, you will think that there is this valid area, okay, like the one that is actually here, that will make the market now do what, buy. Okay, so this is a valid demand area. Hii area iko hapa ni demand, but now the problem is you ignore the trend, and the trend is bearish. Now you're looking for buys from this particular zone, from probably around this area. So the market has decided to dump quite hard. The market has hit your demand. You didn't observe the conservative or the pro entry. You decided to get in with an aggressive entry, and the market does what? Takes out your stop loss and takes you out quite fast. And from there, the market dumps all the way down, okay? But it has to dump in the zigzag manner on how the market moves, okay? So it's important we are able to observe the trend. So don't or never ignore the trend, okay? Just know if the market is uptrend or a downtrend. And that's the first concept to learn, the market structure. It's on 3 types of trends: uptrend, downtrend, now sideways market, okay? The number 3 are using weak zones. Using weak zones. Okay, it's important. Like the one that is actually here. This is a weak zone. Yes, you have observed the trend is sells, but now you want to sell from this particular zone. This is a minor zone. This is a weak zone, and this is the strong supply zone that we actually having. So don't trade from these weak zones. And how can you be able to actually note weak zones and strong zones? It's very simple. The origin of the movement. Your movement iliazanga wapi, and also the freshness of this zone. If this actually zone that is actually here ingekuwa imekuwa tapped and probably we had another zone probably around this particular area, okay, then this could be a very valid supply area. But now the market has not tapped into this area, okay? So don't trade from weak zones, trade from high probability zone, and also wait for confirmations. Number 4, entering without confirmations. Entering without what? Confirmations. And this is something that I've taught you over and over and over again. We have to wait for confirmations. But this is what we're going to look at from next week on Monday, how to be able to enter. Now we have observed all this. We have been able to mark our supply and demand area. Then now the next thing is, how are we able to enter or confirm or note that this is now a confirmation for buy and this is a confirmation for sell? So never get into the markets before confirmations. Now, confirmations is a statement that I came up last year. Don't react before the market does what? Reacts. Okay, so the market has to react first. Ikupe confirmation, then you get in after the confirmation and place your stop loss if you're buying below the demand, if you're selling above the supply. All right, so don't enter without confirmations. Number 5, okay, which is the second last, poor risk management. Okay, poor risk management. Sasa, now, this is a trader who has learned supply and demand, and now they have been able to backtest and also be able to come up with some good entries. And now they think now they can be able to flip your $100 into $1,000 or $10,000 just like that. Remember, these are supply and demand. It's not 100%. It actually gives me an R of around 60 to 70%. Okay, as much as I've done everything, sometimes the market can actually not react on its own, or it gives you some few pips and reacts oppositely, probably because of news, probably because of the institutions or the smart money, or probably because of another thing that actually happened in the market. So we just never know, and that's why it's very important for us to be able to be informed. Okay, probably it's because of news, global news, kuna war. Okay, you are selling gold currently, like how the market opened today on 23rd of February 2026. The market has decided to give us an impulsive move. There was a new week open market gap. Okay, so now you decide now we want to currently the market is selling, so you decide to get into the sells, thinking that the gap is going to be mitigated, but actually either of the countries decides to bomb each other, and gold decides to buy. And do you understand clearly that actually gold is on a bullish run? So those are the mistakes that we usually do. So poor risk management, please always observe risk management. If you're risking 1%, please do so. 1 to 2% of your account profile. Kwa live accounts, usually risk more. We need to make more, all right? Around 5 to 10%, not much, okay? So let's always observe risk management. We don't trade full margin setups unless otherwise, okay? Unless you are trading with $20 up or so, we don't use risk management. Then something else is what we usually call over leveraging. Over leveraging. All right. And over leveraging is one of the bad habits that actually traders do. But over leveraging, these are for traders who actually fund some small amount of money, $20, $100, even up to $200, and you want now to over leverage, you get into brokers who actually don't actually use big leverage, and now you want to have multiple entries on your buy or on your sell position, and you want to make more money because now you don't have enough capital. Okay. So over-leveraging is a very dangerous disease, and I don't want you guys to have it. In the US, they usually use a leverage of 1 to probably 50 or 1 to 100. Here in Kenya, for all the brokers that have been able to be licensed by the CMA, the maximum leverage they can give you is actually 1 to 400. 1 to 400 is a lot. Okay, but now because you are a very smart trader and you've been able to do your research and now learn that there are other brokers that actually give you more leverage and you can actually go to them. That's totally okay. But people who use a big leverage, there are people who don't have big accounts. All right. Sasa kama uko na account mzuri ya $1,000 and above, then there's no need for you to be able to do what? To over leverage your positions or over leverage your account. You can actually use 1 to 400. That's actually quite good. Okay. So those are the common mistakes that we as traders usually do, and it's very important for us to be able to be disciplined and also to be able to check on the market and how they actually move, and also to be able to observe all these. So let's observe all these, the characteristics and how to identify strong supply and demand areas, and also the common mistakes that we actually do and avoid them at all costs. So without much ado, let's dive into the charts and we check some common examples, okay, on how the market has been able to move. Okay, so I'll use a good clean chart. Okay, and I'll be able to use AUD USD. AUD USD has been having some good clean price action. This is on the H4. Okay, so the first thing is identify the trend. Please, if you're in the meeting and you can be able to hear me, please give me the reaction so that you can see we are together. All right, I see you, Gabriel. Thank you. Tuko pamoja. All right, sawa sawa. So let's dive in. Okay, admin Oira, Sam, Aya, tuko pamoja. Now this is AUD USD on the H4. Confluence factors to consider: number one, trend direction, and you have to check it on the higher time frame. You can check it on the daily, on the weekly, on the monthly, on the H4. That's higher time frame basis. Okay, so tunaangalia AUD USD, and you can be able to check it on an uptrend, and this uptrend is characterized by having higher highs and higher lows. And also, if you want to also to check on how the market actually moves, that's one. Two, it's what we usually call moving average, if the market is trading above the moving average. Okay, and clearly by using your eyes, you can be able to see that the market is moving from one low area to the other one. All right, so this is on the H4. Okay, the market has been bullish, and this is where the market started having the bullish run. So the market was on this particular price, pushed high. We had a good break of structure. Market went into a series of consolidation. Then from this particular area, this is where the market actually pushed high. So this is our first level of demand, as you can see from here. Okay, remember these areas of supply and demand, the market can come to it, or the market can decide not also to come to them. Okay, so that's the first demand area that we are having on the H4. Then from there, all right, I want us to check this. Let me just use a replay from this particular area. All right, very good. Now the market started pushing from here. Okay, that area. This was a good area. All right, where the market actually pushed from. Okay, then we had a good break of structure from this particular area. I want us to play this market so I can be able to see. Okay, this is AUD USD on the H4. Then the market pushed high. This was on Friday. Okay, and then the next week the market was very bullish. Then there was this week, the last week of January, the market opened with a good gap that it was actually here. And this is where my interest was. Please bear with me with my mouse. It's actually messing me up, but don't worry. Yeah, from this area. All right. So the market opened up with a gap. Okay. So remember, tuko na hii demand area, and we're having other demand areas that are actually here, minor demand areas. But for me, I usually don't mark them. So the first thing is I do is I mark this area. Okay. You can be able to see that the market was able to mitigate 50% of this new week open market gap. You can be able to see that. Okay. Then from here, after the market was able to mitigate that new week open market gap, the market created an OB on the H4. You can see it from here. You can just mark it out and also mark out the wick that actually went through. All right, so this is going to be our demand area. Now, this is how you can be able to mark them out. So this is going to be our demand area, actually quite there. Then another thing that we were able to see is that these lows, they were actually taken out by the market. So we had a sweep of liquidity. I usually term it as X, or you can also call it TS for the SCT traders, a turtle soup. Okay, let me make sure that it's at the middle center. Okay, so we had a liquidity sweep. Then from here, the market actually did what? Broke the structure. So that is our first indication of a valid supply zone. So we had a break of structure. It's here. You can be able to see it. We had a POS, very valid. Okay. Then after we had a break of structure, the next thing is, did we have an imbalance? Quite well. Yes, the imbalance is actually here. The market has to create an imbalance. Okay, so the imbalance is actually quite there. And also another thing now we wait for is now collecting liquidity. Okay, so we're going to be able to see if the market actually created liquidity. So from here, I want us to go all the way to the H1. So from the H4, I usually go to the H1. And what do I do on the H1? I refine my entry. Okay, I am able to refine my entry. Now, this is on the H4 order block that is actually here. Okay, now what I do, you guys know how to refine order blocks. The last candle or the last, if it's a bullish order block, is the last bearish candle just before the impulsive move, and that's the right marking of this kind of an order block, because this order block is a very important one. Okay, especially for the fact that it was the candle, it was the last candle that swept this low. Okay, just before the market decided to do what? To actually have this buy. Okay, so this is the one that is actually responsible. So I'll mark it out. How do you usually mark it out? You can mark it out from the tip. Okay, I usually use that tool for checking on the price. So the price is at 0.69163. So the next thing is, we now, after marking out, we set alerts at this particular price zone and we wait for the market to come back to that zone. All right, and wait for confirmation. So from here, the price started moving quite higher. Okay, let me just make sure that I have, okay, from here. Okay, very nice. So I want us to check and see how the market moves. Okay, so the market moves, creates the inducement that is actually here. Okay, so this is the inducement. Okay, didn't come back to our area of interest. So it can create now the inducement zone or the liquidity. Okay, how you love to have it, it's more or less the same thing. Okay, and this now is the minor demand area. So we have the most valid demand area, then to corner minor. So this is a minor, and this is what I usually term as the smart money trap, where it can trap you as a trader to get in. Though you can make some few coins there, but it's not a very valid zone to be able to have. Remember, we have the main demand, main to Cornelia demand that actually swept the low, okay, and then pushed high. Then the market is pushing high. So this is on Monday. The market accumulated on Monday, swept the low on Tuesday. The market has been pushing up. Then this is on Wednesday. The market went into a series of consolidation. Okay, let me zoom in. Yeah. Okay, the market went into a series of consolidation on Wednesday. Then Thursday, it pushed high, it can create inducement. So hapa pia, you can be able to get, because there's something that I loved about this setup that is actually here. Pia, on this particular area, it created liquidity on this area. All right, also on the same. But this, it can give you some few pips, but this is the main entry. Check out what actually happened. Then we had NFP on Wednesday, if I tend to remember. It was on a particular Wednesday, the market was able to come, dump all the way down, then market started pushing high. So this was the area also. The market now started creating more liquidity. As I said, it can give you some few pips, but it's actually not a very valid zone for us to be able to target. Okay, so the market is actually creating more liquidity just above our demand area. I want you guys to see what really happened. Okay, so the market created more liquidity, and this is where things got really interesting. Okay, so this is on Monday. Now the following week, after now the market got into a series of consolidation. Now this is where I usually mark out now my target. So this is usually my target, okay, where I want the market to go all the way up to, okay, and my entry is going to be on this particular area, okay. So once the market comes back to this area, I will receive an alert both on my laptop and both on my phone. Okay, I want you guys to see here. So the market taps into the order block, okay, and leaves some good rejection. On the H1, you can be able to see this. If you come all the way down to the 15 minutes, which is actually my entry criteria, you can be able to see that we had some good confirmations from here. So we had three candlesticks on the M15 that were actually having wicks. So the wicks were even bigger than the body. So you can be able to see that this is actually a good and clear confirmation that the market wants to do what? Wants to buy. Get in, have your stop loss below this zone. So I want us all to go to the H1 because now we're analyzing on the H1. So from here to Mingia, where is our target at this particular area? Okay. Now the market pushes high. Okay, pushes high, decide to push high, and this is where we have this big push. So the market, if this market is a valid demand area, the market does not have to come back to the demand area. Probably it will come and react to a demand area that was caused by the market, probably this area, but necessarily, or how the market plays, it doesn't really come back to this particular zone on our entry. So even if you have your PE set, your break even, is going to be actually safe. But this is where the thing that actually was interesting. So this was our TP1. So our TP1 was hit. I was able to take around 50% partials, but now the market decided to come back to our entry and sweep this low. So I want you guys to see. So TP1 was taken. Then this is where now I decided to exit because now the market was not really giving me that big push. Okay. So the market decided to do what? To come back again. Okay. I want you guys to see this. Demand and supply. Okay. And swept this low. So you can see the market decided to sweep this low. Market probably was interested in this low first. Okay. Because this was on Monday and this was on Friday. Okay. This was on Monday, Tuesday, Wednesday, now Friday. Okay, so from here, this is now where the market actually moved high. There's a concept of liquidity. Whenever on the demand area, the market sweeps a low, a previous old low, or a previous old high, the market will really move. And from here, this is where the market now decided to move all the way to full TP. That particular Friday and the following week on Monday, market moved quite well. This is where now the market was interested in taking the high that was actually there. So this is where we had our drawn liquidity quite well, quite good. Okay. Now the next zone is this zone that I actually marked out, and this is going to be a very valid zone for us to be able to do what? To take a trade. And this is where my demand is going to be. If this market can come back to this area, that's going to be a very valid demand area. Okay, the market has pushed high. Okay, another thing I was able to see is this demand area, which was actually also very valid. Okay, what makes this valid? Because we had some sort of consolidation, then the market decided to push high, giving us what we call these long institutional candles, or these big candlesticks. Okay, and this is the impulsive move that actually created by the market. That's an impulsive move. The market is on a bullish run. Now we are looking for buys. This is going to be our inducement zone or our liquidity area. Okay, that's quite good. And now we'll have our entry from this particular candle. And this is the entry that we were able to get in from last week. I was able to share this setup with you guys. So we wanted this imbalance to be filled. We wanted this liquidity area to be collected. So this is what we call collection of liquidity. Tap into this imbalance and also tap to our area of interest, which is the order block. Our order blocks are the entry criteria. So these order blocks, what makes these order blocks be valid is this imbalance that is actually here. So the market pushes high. Okay, pushes high, comes back to this area, pushes even high, creating more of like more inducement zone. And from here, this is now, I want to pause here. This is now where the market, now I found it very useful. whenever you see the market actually dancing just above your demand area, it looks quite skeptical, or actually not very valid. But whenever the market reacts from these FVGs, okay, especially this area, this was Friday's low. Now the market imeingia, so this is going to be our previous day low, PDL. Okay, this is a PDL, previous day low. This is the imbalance. The market has had our good break of structure. This is our break of structure that is actually here. Okay, another break of structure that the market had. Okay, I want you guys to see this. Another break of structure that the market had. The market has been moving high, and this is going to be our target. Okay, that high is going to be our target. Let me delete this for now. All right, this is the inducement zone. This is our previous day low. Okay, so we waited for this setup actually to play out. Okay, then we're going to have our entry there, then our stop loss just below our entry. Then we're going to be targeting what? This high that is actually here. Also to note that this is an old high, but around this area, we're having a supply zone. So ideally, you can be able to have your exit at around that particular area, just to make sure that you're able to maximize on the profits before the market decides to take you out. And this gives us an R of 1 to 4.08. So let's check out how this market will do. Now, this is our supply. This is our supply zone, right? So let's play it out and check and see how it will move. So this is Monday. The market pushes higher, comes back all the way lower. Okay, creates more inducement. Okay, then the market taps into our area of interest, as you can see from there. Okay, so creates more inducement. You can see this candle is actually here, pushed high from this particular area. This is just creating more inducement, and then the market decided to come tap into our area of interest, then had a very good push, which is very good for us as traders. Okay, the market has to push high, making this area of demand to be a very valid one. Okay, then from there the market comes back down, pushes lower, comes back again to this area of interest. Okay, comes back to our demand area. Then the market now sweeps this low, because we have now we're going to be talking about these types of entries. Whenever the market taps, pushes high, comes back, then the market now decides to check out this low that was actually here. Okay, okay, this is sweep of liquidity. Okay, sometimes the market does that many of times. This is the season, or this was the last week when DXY was very bullish and we are looking for buys on AUD USD. We had lots and lots of um resistance to push high, but actually from now Friday last week the market was able to push high, and actually the market is doing quite well. So that's the kind of entry that we were able to have. So those are the areas of demand and supply that we have been able to see. Okay, so that's on AUD USD. I want to go very fast on GBP USD, which is going to be my last setup of the day, and I want you guys to see it on the H4 also, and I will use a different quote provider. Let me use forex.com. That's quite good. Okay, from there, very nice. Okay, forex.com. Kumbe niko na, can we use Paperstone? Okay, quite good. Yeah, from the H4, and I want us to have a replay all the way from this particular zone, from here, just before we had this big push. Okay, so that's how the market is currently. The market is pushing high, creating valid demand areas. The one that is actually here, this is a valid demand area. Okay, very fresh. Above it we have a good imbalance. Okay, then the market reacts from this area. You can be able to see the market reacts also from this area, and this is the demand that has not been mitigated, but it's a very good demand area that we really need to notch it down. Okay, then the market moves higher. Okay, then from here, this actually happens especially when you have a green candle that actually swept, because this is supposed to be a red candle, but it was a green because it opened all the way down here, then pushed high. Okay, that's why it's a green candle. This is a new week candle, and the market pushes higher, and this is why I was able to set my entry, this candle, because it was responsible for sweeping this low, and also these lows. Okay, sometimes usually act as a good demand area. Okay, so the market pushes higher from this area. Okay, I want you guys to see, and pushes higher. Okay, so I was able to have now my entry from this area to this area, because now this is the valid order block now, because this order block was valid because of some reasons. Why? Because now tukakuwa na imbalance, okay, na tukakuwa tena na what usually called the inducement that is actually here. Okay, so it's very important to be able to adjust to your areas of interest. So that's going to be our area of interest. Now this is going to be our demand area that we are having. This is our demand. Okay, then we had good break of structure from this particular area because this was the last high. So we had a good break of structure. We had our BOS. Let me mark it out. Quite there. All right, then the inducement. So good imbalance. So this is the imbalance. I want you guys to see this imbalance is what is very important. This is the footprint that actually the smart money actually leaves behind. Okay, don't ever forget this. Okay, once the smart money actually pushes up, okay, the market, this is the area of interest that we are now having. Upper, this is the origin of the entry. Okay, I want you guys to see. So never forget this. Just a minute. Never forget. Now this is also the entry. Market had a sort of accumulation, then a very big push all the way up. So let's continue playing so that you can be able to see what the market does. Okay, the market pushes high. Now we are always blessed when we are very patient traders. Sawa sawa. The market pushes higher, then the market now gives us this high that is actually here. That's going to be our final take profit. This is going to be our entry, and this is going to be long position, this area. But this, remember, this is GBPUSD on the H4. Our stop loss just below that area, okay? And you can be able to refine it all the way down to 15 minutes time frame, okay? Then we are having, also you can be able to have like these areas as your take profits. So you can have probably take profit 1, TP2, TP3, and then the final TP. It's very good and important to have all those types of TPs. So the market pushes higher, comes to this supply zone. So from here, you can be able to sell the market from here because this is a good supply area. Okay, this is a good supply area that can push the market all the way down. Okay, so tunaweza kuwa tuko na a good sell from here, then a good buy. Confirmation ziko, yes, valid confirmation. So we can be able to take our sales from that particular zone. Good zone, stop loss just above this high that is actually here. Then we can be able to target this low or this demand area. Okay, just some few pips above it. Okay, then that's, so we can have that as our entry around that area. Stop loss is well kept. Okay, just give me a minute. I zoom in. Yeah, so let's see how the market actually behaves from here. So we have a sell and buy model. So from here, the market decides to react from this particular area quite well. So let's see if it will be able to drop from there. Okay, and the market drops. So we're able to have a good sell from that area. So now I want us to see if our take profit from the sell was actually happened. Okay, and actually, did we have a good entry on our demand? And as you can see, the sell from here valid 5.6 is R bagged. Okay, this is the supply. It has all these things: break of structure, imbalance, okay, and also the inducements. Market reacted from here, okay, and actually dumped. Then on Friday, okay, market reacts quite well, and also we were able to learn that after on Friday we had news that Trump's tariffs didn't go well. The court ordered against his tariffs, and that is something that we were expecting, that the dollar is going to dump actually, because it's not going to be strong, as you can be able to see. So what I said, whenever we usually have tariffs on board, and whenever Trump issues his tariffs, we usually have the dollar dumping. And whenever we have negotiations, the dollar is going to pump. So this week we were expecting the dollar actually to dump, and it's actually happening. Okay, and we were able to see now from here, the GBP/USD, the market has reacted quite well from this area of demand, and it has pushed high. So this is going to be our target. So because this supply has already been tapped in and mitigated, now for GBP/USD, I believe now from here, our work is simple, just to look for buy setups this week all the way up. to that particular high. So this is on the H4. So we can be able to come to lower time frames now and check what is happening from this area, especially this structure is actually here. We can be able to get some good trades. Okay. So most of the time I usually avoid Mondays, especially Monday London session. I usually trade during New York session. So this is on the M15. So we were checking on the H4. So this is on the M15. So for us as traders is to check where we have an imbalance. So you can see we don't have any imbalance from here. This is where we had an imbalance and an impulsive move. This is where it actually originated. This area was tapped in. As you can see, the market was able to come back, then pushed high. So where is the last area of imbalance? Is actually going to be where? From this candle that is actually here. So if I'm supposed to send you any signal whatsoever, it has to be from this particular area of interest. The market has to come back to this area, take out this Asian low. Okay, you guys know we usually trade Asian high, Asian low on currencies. All right. Okay, take out this Asian low. So this is going to be liquidity for us. This is going to be our area of demand. Okay, fresh area of demand, economic imbalance, which is actually quite good. Okay, and also it has a good break of structure from this particular high that was left out. Can be able to see we had good valid break of structure. The markets we're expecting now to come pull back to this area of demand, then we're going to have a good buy from this area. Okay, stop loss just below that zone, and then we're going to target this high as our target, or also you can be able to target let me make sure that this is visible on until the H4 so that you guys can see. So I want us to check on the H4. So this is our H4 setup. Okay, it's the one that is actually here. So the market to come back to this area, okay? Then from that area of demand, which is a very small one, the market to tap to this Asian high, and also we can be able to actually increase our TP to probably this area. This is also a supply zone. Okay, a very valid supply zone. So we can have those exits from those area. Okay, once it passes through this particular zone, we can also have another re-entry. So once the market actually passes through aggressively to that zone, you can be able to have another entry from this zone. This is going to act as a breaker now. Okay, then the market is going to push high and high because our target at the end of the day is this particular high that was left out on 27th of January 2026. So that's going to be our drawn liquidity as for now. But hii ndio setup tunaitafuta on the M15, and this on M15 is giving us an R of 5.03. But if we increase, yeah, that's good until that particular area. So it's as simple as that. So trading is very simple. The only thing is we usually complicate it, okay, by not applying proper risk management, by not following your rules, and by not being patient enough as a trader. So those are the things that usually complicate. So this is a good valid setup, okay, that has happened on Monday. This was an OB that happened at around 1 a.m. today on Monday. The market pushed high. The market may get into a series of consolidation. So this consolidation is an area I usually avoid trading. So the market has that. So it's either two things that the market can do: either dump to a demand area, okay, or to pump to this particular supply, and this supply, it will make the market all dump all the way to this demand, then we can have a good buy. So two things we are going to be waiting out for after the market now is done with this accumulation phase. Accumulation phase is a signal that we don't have smart money footprints. Impulsive moves, imbalances, fair value gaps, and demand areas and order blocks, those are footprints that smart money were there. They were able to push the market from this particular low all the way to this high. The smart money, they were able to enter from this area, okay, and they were able to exit from this area. Then the people who are left accumulating and also dancing the market this way, these are retail traders. This is me, and this is the likes of you, and this is the likes of hundreds of others across the world. Okay, so our work is simple because we trade the SMC way. It's way to wait for the market to come back to this area. And this area, we got another thing that is actually quite good. We had a sweep of this low. Okay, that makes it actually more valid. Simple as that. I can address some 1, 2, 3, 4 questions now before we end the session hapo hivyo, but that's the core principles of supply and demand trading. But I usually include other ICT strategies also to be able to have a refined kind of a strategy that can give me a win rate of around 60, 70, up to 80% win rate. All right. So any questions until there? I hope you guys have been able to enjoy the session and be able to understand the supply and demand kind of a strategy. And this is what I usually use daily for day trading and also for swinging my way up and also for scalping. Okay. So I also use all of them. So any questions still there? I'd love to answer some few questions before now we call it a day.
I have a question.
Yes, Fidel.
Hi, how are you? I think this is the
I'm
first
very
time I'm
fine.
talking to you, actually.
Amazing.
Question. What do
Yes.
you do when you're late? For example, you get an alert, you don't see it, and then by the time you come to the markets, now you're like 2, 3, 4 candles later. Do you ignore the setup completely, or do you scalp it? And if you scalp it, then how do you go about that?
Good question. Good question. Now I will answer that using a mechanical entry and also um, uh, uh, that's what we usually call a mechanical entry. Now you're going to have a mechanical entry because we don't leave setups to go. Okay, we have to actually do something. Okay, is a setup. I want to share this setup with you guys. Was it Euro USD or it was which setup? I just want to check and confirm and see. Okay, what you can be able to do. So there are two things that are involved here. I'm using currencies because currencies are easier. I don't want to go to gold, and it's not because I don't trade gold. I trade gold. Okay, so let's do this. Let's use this as an example. This was on our OB. So he has asked a very good question on when we had an alert, but now you are not online. The market actually taps into an area of interest and it has actually pushed some 2, 3, 4 candles above. So what do you do? Do you leave the entry or do you actually have an aggressive entry? Probably, or what can we be able to do? So the market, probably this is on the H1. The market, when you go all the way down to lower time frames, you'll always have to get an entry. Okay, you'll always have to get an re-entry. Okay, so for me, there are two things involved. The first thing, number one, if the market actually leaves me, which is very rare, but if it actually leaves me, number one, you can be able to have what you call a mechanical entry. And this mechanical entry, you're going to be able to divorce your strategy in a way. Okay, because now I usually trade using order blocks. You can be able to trade kwa fair value gaps because you have missed out. Okay, those are the disciplines that you have. So that's what I usually call a mechanical entry. Or number two, you can decide now to do what? To leave it. Okay, so two things involved. Either you have a mechanical entry, or you can be able to decide to leave it and say, because sasa hii entry imeniacha, let me just leave it. But that's what I used to do earlier, back in my first and second year when I was trading. But I came and realized later that you can have a mechanical entry and be able to actually get some good pips. Not maximum pips, but you can also get, if you can get 80% of the entire move, that's also not bad, or 60%. Okay. So the mechanical move, you will have to ignore now so many things. Okay. So the first area, because now the market, you can see clearly the market reacted from this area. The market has been pushing high, no imbalance whatsoever. So what I usually check on the M5, it's also demand and supply. So this demand and supply doesn't work only on higher time frames, it also works on lower time frames. Okay, I want you guys to see this because now this was the reaction the market had. This was the valid area of interest. So this was the last bearish OB that the market left before now the market had a push. The market didn't come back, but majorly and most of the time we'll be able to see that the market will come back to this area and push also high. If you're not going to see that, then it will happen later on, probably from these particular areas. Remember, this is on the M5. Okay, and M5 is very, very volatile. You can be able to see this market was able to come back to this area, okay, and also have a very good push all the way up. So what I usually do, I come to the lower time frames and have a mechanical entry, okay. Either I can decide market ikiingia to ikipush high, okay, gives me a very good push, okay, on the M5, M3, or on the M1. I'll wait for the market to fill that imbalance, and I'll be able to get in after good confirmations from this area so that I can be able to have a push all the way up. So two things, but I'll prefer use the mechanical model. It's a mechanical because now you're going to be not really forcing, but you're going to be now squeezing and getting a re-entry because you missed out on the first entry. And remember, the first entry or the entry where you enter the market is very, very crucial. Okay, it matters a lot. So this mechanical entry, if the market moves according to my analysis, I'll be able to break even very, very early. Okay, because I'm aware that two things can happen: either stop loss igongwe, or the market can move all the way up. But this is a mechanical entry; it is not a sure entry. So I will do that. Also, the same thing. The market came back to this area, as you can see on the M5. Okay, and the market reacted from this area. So this is a mechanical entry, as you can see, a good push, okay, and then you can define it all the way down. It had a good push, break of structure, imbalance, the market came back. This is a mechanical entry. Then you target this high or the high that you are targeting all the way above, okay? Then also, after the market had a good push, you can see there's a wick that was actually here. Also, this is a mechanical entry. The market had a good push. So those are the things that you can be able to do and also be able to profit from the market, Fidel. So go on a mechanical entry. Go all the way down to lower time frames to be able to confirm. I hope I'm clear until there. Perfect, 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 perfect. All right. One last question before we call it a day. Are we good? If you're good and if you've been able to understand, you can give me those reactions so that we can close the session. You can give me those reactions so that I can understand that you guys are okay. Simon Mari, thank you so much. Who else has been in?
Hi.
Yes, hi,
Hello.
Jenny. Yes, Grishon, I see you. Gabriel, Sam, I see you. Yes, Jenny, you have a question?
Yeah, I had sent a message on chat. I was asking if it's possible we get the recorded lesson after this. Is it possible? I saw you had
Yes.
recorded.
Yes, very possible. You will give me around 30 minutes. I have the recording posted. Then I will share this recording immediately once it's live and on our YouTube library. So you're going to be able to have it.
Thanks. Great.
Okay. And also about the last two sessions that we had, there's the first one on the market structure. I will share out with you. We didn't have a recording on the other one on the imbalance, but it's part of what we have done today. Okay. So the imbalance one, I didn't record it. But for today, the supply and demand has included market imbalance and market inefficiency. So you're not going to miss out on everything. So it's going to be there.
Thank you very much.
Karibu sana. So can we end our day there? Then we can have Brent, if he's in a position to share his screen. He can now start. We can start now analyzing the market and see what the market is doing currently as I am uploading this video. So thank you so much, guys. It has been an awesome session. See you next week on Monday. But we're not leaving yet. Thank you. I want to end this recording now.